Hello, good evening everyone, wherever you're watching me from. This is Jai from New Money Methods, and in this video I'm going to show you how you can spot market trends using technical analysis. So technical analysis is good in the way that it's going to tell you the next move that is likely going to happen in the market, and this is going to help you to improve your chances of winning and get out of the markets as fast as possible, because you understand, the longer that you spend in the market, or the more time that you spend in the market, the more you're increasing your chances to market uncertainty. And when that happens while you're in a trade, you then increase your chances of getting a floating loss for some time, or even losing money in the end. So you need to enter right in the market when you know the market is going to make the next movement, and be able to exit the market as fast as possible. So in this video I'm going to share that. I'm basically giving you the techniques that you can use and technical indicators that you can use together with the market structure to help you get out of trouble. So if you watched my previous video, I talked about different market structures, and we talked about the uptrend, the downtrend, and the sideways market. So this is going to be the continuation video. So if you did not watch the previous video, I will link it down into the video description, and you can watch, then come back here. So let's get started with this video. So before we get started, if you're the kind of person that likes to do Binance spot trading, go ahead and smash that subscribe button, like the video. You can as well as share it with your friends, and let's get started right away. So there isn't an embarrassing moment like this moment. So for example, if you look at this picture, you notice in my previous video I talked about buying the dips, right? So if you are running this kind of strategy, you want to buy here. Let me have my pen here. So if you are running this kind of strategy, you are basically buying the dips. So you're going to enter the market at this point, ride this short trend, and be able to exit at this point. Then after exiting, you could again enter at this point after the market has dipped at this point, and take your profits right here at the end of this big run. So then you could again enter right on this point. You could enter again right at this point and take your profits on top there. But now here, if you are an amateur or you don't know anything about technical analysis, you would again buy at this point, right? You see where I put the buy? Okay, so if you buy here, and sure enough, market tries to recover, but then after that, boom, it falls down, and it now changes from an uptrend to a downtrend, right? So it starts a downtrend as a new trend, and sure enough, you have to wait until the downtrend is over, and then it begins a new uptrend, boom, and again then you can make back your money. But now notice something here. From the time that you bought, the market had already changed its trend from an uptrend, so you did not see that coming, and you ended up buying as you're buying the dip, right? But immediately after buying, sure enough, market continues falling because it was a downtrend, and amateurs got trapped here. But now the most challenging thing is that you take notes of the day that you took this trade, right? This was Thursday of 8th December 2022. And sure enough, market dropped from December 8th until this point in time, which is 23rd of January, and that was 9th. It was Monday, right? So it literally took you from December to January for you to break even. Just notice that your money has been trapped for more than 1.5 months for you to make a profit. And this is very common with the beginners, or anyone that is not able to read this price and be able to use these technical indicators to differentiate a trend continuation from a trend reversal. So this is what this video is going to be about, and let's continue. So we said on an uptrend from the previous video, markets make series of higher highs and higher lows, just like I explained from the previous video. So please, if you did not watch the previous video, again, I'm going to link it down into the video description. Go ahead and watch it so that you can get clear narrative of what exactly I'm talking about. So we said on an uptrend, markets make series of higher highs and higher lows, right? So higher highs and higher lows. So that is a clear sign of an uptrend. And still in that video, we said, unless this series of higher highs and higher lows are not broken, then still we'll continue having a clear uptrend. Not until when these series are broken, then we are going to have a reversal from the trend. So meaning it's going to reverse from an uptrend to either a sideways or a downtrend. And sure enough, if you see what happened right here, so we had series of higher highs here, higher highs, and right at this point we had same highs, right? So if you can look, let me just draw it good here. So we had a high, we had a higher high, we had a higher high, higher low, higher high, higher low, and then at this point we had a same high. So it could not overtake this previous high, so they made what we call a same high, and this is a good pattern actually called an M formation, and this is a good reversal pattern. So for everyone that did not see this, sure enough, after making this same high, what would have been a higher low went even more below the previous low, and we said on an uptrend it should be above the previous higher low. So it went below the previous higher low, not making a higher low this time, but making a lower low. So this should have shown any experienced trader that this trend, something is going to happen. And sure enough, after that, the next move up could not again reach this same high right here. It made a lower high, right? So it made a lower high and again retested it, and sure enough, after that we had a trend reversal into a downtrend. So for any inexperienced trader that did not see this, trust me, they could have bought somewhere here and experiencing this trade to go above these highs to take profit right at this point, and sure enough it could not go there. So I've reversed into a downtrend, and again taking you about 1 to 2 months to get your money back, or to exit the markets with a profit. Or else if you want to exit the markets as fast as possible, then you would exit with a loss, which is not an ideal in trading. So this is the clear narrative of what exactly price action says in these types of markets. So let's again proceed to the next slide. Okay, so the next indicator we are going to talk about is called a moving average, right? So moving averages are technical indicators used to determine the trend direction, and I'm going to show you what they are and how they are used just in a while. So for an uptrend, moving averages cross below the prices. So let me just explain to you what happens. Okay, let me have my whiteboard right here. So when you have moving averages in the prices, so let's say this is the market and it's coming down like this. So then here we have trend reversal, and now a downtrend changes to an uptrend. So this is how your moving average is going to come like. So let me just have a different color right here. So your moving averages are going to come like this. So this is a moving average, and we said with an uptrend the moving average is going to close below the prices. So take the moving average as something that carries the market. So with whichever moving average you are going to use, should always carry your market. So during an uptrend, your moving average is going to carry the market prices up. So during the downtrend, your moving average will sit on your prices and force it to go down, right? So this is the narrative with the moving average. So whenever you have an uptrend, your moving average will cross below the prices, and then your prices will start going up. So this is in an uptrend. Again, going back to the slides. Okay, so we tend to use two moving averages, and I'm going to show you them in a while again. So the moving average is 40 EMA crosses below 20 EMA. So having two moving averages just like here. Okay, so this is one moving average. Let's just take this as 20 EMA. So this is 20 EMA. 20 EMA, and then I'm going to have a 40 EMA, and we said during an uptrend 40 EMA will close below 20 EMA, and that is going to signal up an uptrend. So the crossover that happens right at this point, let me change the color. The crossover that happens at right at this point is the one that makes sense for these types of markets. So let me again, I'm going to show you in the live charts. Don't worry, it may seem confusing as for now. Just hold on for me. In a while you're going to see what these moving averages do. So all moving averages have to be facing up. So we are talking about an uptrend, and once all the above conditions are met, wait for the price to retrace to the moving averages, then you can buy. So that is with an uptrend. So the opposite occurs when the market is on a downtrend. So we said an uptrend is a complete opposite of a downtrend. So something that happens on an uptrend, then the opposite is going to happen in a downtrending market. So let's proceed to the next slide, and then I'm going to show you how you can use these moving averages to help you tell the direction of the markets. Okay, so this is the price chart with the moving average, and we have the blue line as the 20 EMA. Let me have my pen. So the blue line is the 20 EMA, and the red line is the 40 EMA, right? So these are the exponential moving averages. So what happened is that on a downtrend, and you have 40 EMA. So on a downtrend, you have 40 EMA above 20 EMA, right? And both moving averages have to be sloping down. So they're indicating that the market is going down. So they have to be sloping down. Now, when you have a reversal from a downtrend to an uptrend, you have this crossover. And this crossover happens in two ways, just like I'm going to show you. Just like I'm going to show you right here. So on a downtrend, then changes to an uptrend. So what is going to happen is that you're going to have a one moving average, which is 20 EMA, is sloping down. And what happens, the first sign of an uptrend is that on a downtrend, the moving average is above the price action. So when it changes to an uptrend, that means the moving average is going to close below the price action. That is one sign. So once it crosses below the price action, it has to change the direction, and now from facing up, it flattens, and after flattening, it then changes and faces up. So this is going to be an indication of an uptrend. That is one moving average. So if it's an uptrend, then it's going to face up and continue going up. The another condition is with the 40 moving average. So 40 moving average, the blue line, is also above 20 moving average on a downtrend. So when the trend reverses into an uptrend, the 40 EMA also has to cross below the price action and again cross the 20 EMA and also flattens, and after flattening, it starts facing up as well, right? So these moving averages, they will help you to tell you the direction in the markets. And then we said once the crossover has happened, once this crossover of the two moving averages has happened and the moving averages are below the price action and they are all facing up, then we call this a sign of an uptrend. So this is a good uptrend. That means you are going to be buying, you are going to start buying. But here's the thing, when the market is on an uptrend, we said it is making higher highs and higher lows. So this is going to be your moving averages, right? These ones right here. So when the market is on an uptrend, you don't just buy, right? You don't just buy at any point, because still, for example, if you happen to buy at this point, it means the market is going to go up slightly, and then you have like a day or two when market is dipping on the correction. So we said after you have confirmed that this is an uptrend, you have to wait for the market to retrace to the moving average, then you can buy exactly at this point. So this is a good buying point. And again, as we go on, as we proceed with these tutorials, I'm going to show you even other indicators that you can use to even target these entries much better. So the moving average this time is going to act like a level of support, right? So it is going to support the prices not to go below this moving average. So it's going to keep supporting price, and every time the price comes to these moving averages, they are supported, they bounce back. Every time the price comes to this moving average, they are supported, they bounce back. So this is also a good buying point, as well as this one is also a good buying point. So you are going to be buying these markets immediately they hit the moving average and they are bouncing back. They hit the moving average, they are bouncing back, and you're going to be buying, right? So let's again go back to our slides. Okay, so from this, let me try to zoom in here. So from this chart, you could take notes that after this crossover, this was a good indication, not actually on a crossover right here. So you could see that the first sign of the change in trend was the crossing over of these two moving averages below the price action. So on an uptrend, the moving averages have been above the price action. But now when the trend changes and it's an uptrend this time, so we expect the moving averages to change and move below the price action. So this is the crossover. Moving averages cross below the price action at this point. And after crossing over, sure enough, after a short period of time, we also have these two moving averages cross over. So we have the 40 EMA crossing below the 20 EMA. So the crossover confirms the beginning of a new uptrend. So after the crossover happens, then wait for the price to retrace to the moving average, and when you see it bouncing from the moving average, then you could buy there, wait for price to go up, then you can take profit at that point. So this could have been a good buying point right here. You take profit right here. So and then again wait for market to retrace to the moving averages, and after noticing this bounce off, buy again here, then ride a trend, take profit somewhere there. Let the price again come to the moving average, and when you see it bounce back again, buy here and take profit here, right? So if it comes back again to the moving averages here, it's bouncing, buy again here, and sure enough, when it comes to this point, take profit. But now at this point, you notice it makes same highs, right? So when the price makes same highs, it kind of forms like an M pattern, and this is a good reversal sign indicating that the market again is going to crash, right? So you could have not taken this trade, and sure enough, after these same highs, the next move down, which would have been higher low, it now becomes a lower low, right? So an experienced trader wouldn't have taken this setup, or you could take that setup with just a small take profit, so maybe 2% or 3%, so that you exit the markets very fast, because you note something fishy here and you don't want to be caught up in the market. So this is only for experienced traders, right? So let's again continue to the next slide. So one of the other things that I like so much happens to be the trend line. So trend lines are good in the way that they also support the price action not to go below or above a certain point or a certain price level, right? So we're going to look at the trend lines, and basically what trend lines do is that they kind of like consolidate price action within that channel, right? So if you look at the market coming this way, and at this point it touches this level, goes up, comes back to this level, goes back to this level, comes back to this level, and right at this point it kinda breaks it, and sure enough, after breaking it, it starts its new downtrend from the channel. So what these trend lines do is that they act as levels of support and resistance. So support, it means it is going to support the price action not to go below this point. So, and the resistance means that it's going to resist the price. So it's going to act like a ceiling to stop the price to go above this point. So not until the price action breaks from one of the two sides, either from the downside or the upside, and then it should give us the prediction of the next move in the market. So as for this case, the price breaks to the downside and sure enough retests these points, and after the previous support becomes resistance, sure after that it starts a new downtrend. So sure enough, after inputting the trend lines, you can see the market comes this way, consolidates within a trend line, and what happens is that at this point, you recall right here we had same highs, and after these same highs we said you should be able to suspect something fishy coming. So sure enough, after the drop this time, it takes away the previous higher low and makes a lower low. But so after the break of this trend line, you would know that this channel is now broken and possibly the price is going to start a new uptrend. So you would not take this next trade right here. So you have to be able to use these indicators collaterally so that they give you better insight of what is going to happen next in the markets. Using these indicators collaterally could help you get out of trouble and time your entries much more better. Okay, so this is the very chart that we started with, and by looking at it from higher highs, right at this point, it makes same highs, and sure enough, when it came down, it could not bounce off from the moving average or from this trend line, so it breaks below the trend line, and sure enough, this was the beginning of a new downtrend. So you should be able to draw these trend lines. They should help you. If you don't have the trend line, then you can as well as use the moving averages. So once you have the moving averages, could come like this, and they support the price action this way. So once you see the price breaking below the moving average, then you would suspect something fishy going to happen at this point. So you should be able to take note of these higher high points, higher low points, lower high points, and lower low points. This is to do with price action. Then you should be able to take to notice the movement of the moving averages. The moving averages EMA that is going to be 20 and 40 EMA. Then you also should be able to at least draw these trend lines to give you support and resistance levels, and being able to see where the price breaks above or below the trend line, and being able to determine the next move that is going to happen. So if the price stays within the channel, then you're right to trade and exit close to the support level, right? So it comes here, trade, and be ready to exit somewhere slightly below the resistance level. Okay, so this is the same chart with trend line and the moving average. So you had your trend line being tested here, tested here, tested here. So right at this point, it was broken, right? So no one would have taken this trade right at this point, because the moment you took this trade, the markets continued going all the way up. So it was already confirmed that this is no longer an uptrend. And how did we confirm that? One, the price broke below this trend line. That is one. Two, the moving averages, we said on an uptrend, the moving averages have to be moving below the price action, just like you can see at this point. So the moment moving averages close above price action, just like at this point, you can take a look at this crossover. Once the moving averages close above the price action and the 40 EMA has crossed above the 20 EMA, then you'd suspect a new trend being formed, and that is a downtrend. So these are the points that we are going to remember for this presentation. So we are always going to be buying on the higher lows or lower lows. So you have to wait for the price. The price is going up, you have to wait for it to come back down, then you can buy, right? Something like this. So this is going to be an uptrend. This is an uptrend. So on an uptrend, you have to wait. The price goes up, makes a higher high, then retraces down, makes a higher low. So you're going to be buying when the price is moving from a higher low, going for the next move all the way up to the higher high. So when the price reaches towards the higher high level, then you can take profit and exit the market. So we are always buying dips. Those are called the dips on an uptrend, right? So those are the higher lows. So on a downtrend, if you happen to buy on a downtrend, which I wouldn't advise for the beginners, but if you happen to, then you want to buy rallies on the downtrend, right? So this is the market moving like this on the downtrend. So what you want to do, you want to buy lower lows. So the market has moved lower, has made a lower low. So you want to buy on these rallies on the downtrend when market it goes up slightly to pick more orders before it continues going back again. So you want to buy at the lower low, so that as market is correcting slightly here, you make a few profits, maybe like 2% or 3% sometimes. Then you exit the market before market even goes lower. Okay, so you always have to take profit on the previous higher high level. So if market is like this on an uptrend, so if you buy at this point, you buy here, you should be able to at least take profit right at this point. So this is going to be your take profit level, right? So always take profit close or slightly above the previous higher high. So again, it's like this. So if you buy here, be willing to at least take profit at this level, right? Okay, buy, you have to buy when price falls to the moving averages or support level. Now, as we said, when the price is going to like this, so it is going to be making some sort of a support level right at this point. So you can put this support level using a trend line, or you can use the moving averages. So always wait for the price to come to the trend line or the support level, and when it starts bouncing off, then you can buy that, right? Or else you can use the oversold oscillators, and the best one is stochastic RSI, right? RSI, that is the best one, but there are a lot of these ones, the MEDI, that could help you to tell that the price is right now oversold and it's going to it is ready to make its move up. So these are the indicators that I use on the daily basis. So these are the very indicators that we are going to be focusing on. So practice drawing them. In the next video, I will show you how you can implement them into the live charts, and basically how you can use each of these to filter through the right and the wrong signals, which ones you should take, which ones you should avoid, and the correlation between the three. Because once you find three of these indicators are correlating, they are all telling you to buy, that should be confirmed buy. That's a sure win signal. So that was it, guys, for today. It was a long tutorial, so I will see you in another one. Bye bye, take care, happy trading. If you have any question, feel free to put it down in the comment section. Like the video if surely you did. Subscribe to my YouTube channel. I will see you again in another one. Bye bye and take care.